All right. Hello, everybody. Welcome. My name is Tim Hart, branch manager of VanDyk Mortgage, right here in Fort Myers, Florida. Today, got my buddy, my pal. He is my. I'm not even gonna let you introduce yourself, Rich. I'm gonna just talk about you, okay?
Perfect.
Yeah, Rich Passanante with VanDyk Mortgage. He is our lending operations manager. He's one of our big dogs. Rich is the guy that I use all the time when people say, what's the difference between you and big banks? What's the difference between you and a mortgage broker? It is people like Rich who, one, know everything there is to know about lending. He's a chat, a phone call, email away, and I can bounce everything off of Rich. He gets back with me and my team in no time, and he knows everything. So, Rich, thank you for being with me today, bro. I appreciate it.
No problem, Tim. Happy to be here.
Good. Did I do okay with your intro? Are you all right with that? You agree with it all?
Yeah. Awesome. Yes, for sure. Love it.
Okay. I felt like a little bit like a WWE wrestling announcer right there introducing you. So I got a little excited.
Well, go with
All
that.
right. So you guys, what's that?
I was going to say go with that because those are essential here in Florida right now.
Yeah. Yeah. Oh, that's right. WWE is. Yeah. You got to have that entertainment. So if you're watching this, I really wanted to bring Rich on for our realtors and potential home buyers out there during the coronavirus and this whole pandemic. A lot of changes has happened in lending, and I know a lot of you out there have a lot of questions. And so we'll go through with Rich and kind of hit on some specific topics that are out there, especially if you're a realtor in this business. Stay tuned. Listen to what Rich has to say in some of these answers. So I think you guys are going to learn a lot from it. So Rich, before we get started, you got anything you want to kind of get out of the way first before we talk about this, just from your perspective?
Sure. It really is a hectic time right now in real estate and lending and just, the world, the country, the economy in general. However, I don't know. I worked in the industry and then in the business throughout 2006, 7, 8, 9, and this feels a little different. It feels like it's from some kind of external source almost. It's not like we created the problem ourselves. And
Right.
I don't know why that gives me some kind of comfort at the end of the day that, everything, at least with hopefully it's just not a long-term, it hasn't been systemic issues, I guess that we had to work ourselves out of and dig out from, back in 2008, 2009, stuff like that. So, that does make me feel good. And knowing that, we've been making smart lending decisions for the past, 10, 12, 13 years makes me feel good too, that, all the borrowers that we are working with, we truly are looking to set them up for success, making sure that they can repay the mortgages that they're applying for. So that does give me a lot of peace of mind at the end of the day, and helps with my not to have any anxiety about what we're doing or our jobs or stuff like that.
Yeah, a great point, man. The perspective of going through 07 and 08, with us being in the middle of it. Like it was melting down all around us. That is really unique. I haven't thought about that, but I feel the same way, man. Now you bring that up, like, you don't feel like you're more on the outside of this one, kind of like, all right, well, it's going to end sometime, and then we'll be right back to it. Where 07, 08, you're like, holy cow, man, I may not have a job tomorrow, like we may not have an industry tomorrow.
Well, also, like, we don't feel like the bad guys right now necessarily.
Not yet. Give it time. Give it time.
Right.
Well, hey, let's get into some of these questions, okay?
Yeah.
Okay. So I'm going to give you a layup right here up front. This is one that I get a lot. But, Rich, can we close a loan in 30 days?
Yeah, for sure. Certainly. We are working hard to, obviously every lender's had a huge influx of business right now because of all the refinance applications that are out there. At VanDyk Mortgage, we are still closing our loans within 30 days. We are looking to close our refis in 30 days, and our purchases, we are doing everything we can to meet those contract dates. So, if we get less than 30 days on those, we know purchase is here as the cornerstone of our business for the long term. So, we're going to make every effort to make those dates happen for everybody.
Yeah,
I think
VanDyk definitely is purchase centric for sure,
yeah.
and should be. The next question I was going to hit you with was appraisal. Before we get into that, though, one thing I noticed, delays and appraisals really in Southwest Florida didn't really pan out like I thought. I mean, I really thought I was going to have a lot more delays on that, but are they absorbing it across the state, or are you seeing delays out there?
So I think what's happened with the delays, and this is something else that makes me feel positive about the industry and everything that's happening within banking and mortgages right now, is that, the agencies, Fannie Mae, Freddie Mac, FHA, VA, all of them, came out very quickly and strongly with alternatives to requiring a full interior inspection for different kinds of transactions based on, whether or not they were a purchase or a rate and term refinance or a cash out refinance, or whether or not they, the application, depending on how much risk there was in the application, that, there are all these alternatives to needing a full interior inspection, which has really helped mitigate the need for appraisals right now. So, appraisers not having to do full inspections everywhere. They can just do a drive-by or a desk review appraisal, or even getting appraisal waivers with Fannie Mae and Freddie Mac. That's really helped appraisers keep up with the demand for the appraisal orders that they do have.
Yeah, good point on the waivers, because they don't. I mean, we're getting them on.
Mm-hmm.
I don't know what percentage you guys are getting them on, but it seems like almost every other one.
Yeah.
That's 80% or less seems to maybe be coming up with one. So that definitely helps with volume. Now, if a seller doesn't, when does an appraiser have to do, or when is an appraiser allowed to do exterior only photos on an appraisal?
Sure. So for the purchase transactions, if the property is currently occupied either by a seller, a tenant, or the current owner, meaning like in the case of a refinance, if the people occupying the property refuse the inspection, the interior inspection, the appraiser can then, has options for what kind of report he can deliver. So for example, if the full interior exterior inspection is declined, then the appraiser can either do a desk review appraisal, or most oftentimes what we see them doing are called exterior only inspections, or what's more commonly known as a drive-by appraisal. Now, it's not really a drive-by appraisal, like I think a lot of us might remember, where the appraiser literally just used to drive by the property and be like, oh yeah, it's there. They still do need to go and walk around the outside of the property and look for any kind of, physical defects or, anything that jumps out that's noticeably, might be wrong with the property. But it is called an exterior only inspection. It is quicker. And then this way they don't have to be entering the property and potentially, getting an infection or passing infection on to anybody.
Yeah. Huh. Good to know. And, bringing that up though, like I haven't heard of really any of our clients refusing entry. I haven't. Maybe it happens and I don't know it, but I haven't really seen it too much. So that's kind of neat too. It's just really neat, man. Oh, go ahead.
I think it depends on which market you're in. Like you said, Southwest Florida, just knowing more about what's going on with coronavirus in Florida than other parts of the country. Southwest Florida, I think it's been, thank God, a lot quieter. Same thing around Tampa Bay. I know,
but like Miami,
Florida,
be a different story.
Right? Yeah. I know up in New Jersey, New York, places like that. People don't want appraisers coming into the house. Same thing I've seen around the Chicago area. Stuff like that.
No, that makes sense too. So the other thing, or one of the other things I want to touch on is employment. So this is a biggie.
Yeah.
Is that we've seen so many, I don't even remember what the number is at right now, millions that are unemployed right now just in the last month. So I want to touch on two things. One is someone that's been furloughed. three, maybe, if you don't mind. I may sneak one in there on you. I'm gonna give you a heads up. It's gonna be working less hours. Okay, so I'm gonna
Yep.
give you a few minutes to think about that one. We'll hit that one at the end. Furloughed employees, fired, right, and then less hours. So
Yeah.
let's hit the furloughed ones first, because I think that's going to be very interesting to people out there that are watching this, about a borrower that's been furloughed off a job, meaning they're not working right now, but how do they still buy a home?
Sure. So for a borrower who's been furloughed, we can still do a loan for the borrower. There are a couple of things that we're going to be looking for. The first is we're going to be looking for what's called an agreed upon return date. So that's written confirmation from both the borrower and the borrower's employer of the date that it's anticipated that the borrower will return to work full time. And so long as it's prior to the first payment date, we can qualify the borrower using their pre-furlough wage. Meaning, if they were salaried for $3,000 a month, we could use that $3,000 a month to still qualify them, so long as their anticipated return date is prior to their first mortgage payment date. So that means, if you're closing at the end of April, you're anticipated to return to work sometime in May, your first payment's in June, there's no impact to you. Now, for borrowers who are furloughed longer than the first payment date, we can still qualify them. We can qualify them using whatever kind of unemployment or temporary income they're receiving in the interim before they return. And we can also even supplement that unemployment wage with reserves if they have it, to qualify them at their pre-furlough income.
So while they're, let me just get clarification on something here. So if they're furloughed and they're on unemployment and their start date is after the first payment due, you can actually use the unemployment income?
You can use the unemployment income, and if that's not enough to qualify them, there is a calculation that you can use reserves to help supplement that unemployment wage to get them to qualify.
Okay, cool. That's great info, man, because a lot of people are going to need to know that.
Yeah, what's really important about that is, it's not like traditional unemployment where you go on unemployment, you don't have a job that's waiting for you, and there's kind of no end date in sight. It is for borrowers that have a defined, this is when we expect you to be back on the job full time.
Right. That time, though, just happens to be after their first payment being due.
Right. Mm-hmm.
Yeah. Okay. I got you. That makes sense. Okay. So someone, they just got fired and they want to buy a house, or they're in the process of buying a house. How do we treat that?
Yeah, unfortunately, if a borrower has been terminated and there is no, like it's only temporary, we can't do a loan for you. You do need to have employment and a wage that we can use to qualify you. So
you're getting really picky, Rich. Really picky.
I know. It's crazy. But yeah, so if you've been fired and there is no indication that it's just temporary, we cannot approve a loan for you right now. However, if you are back in the job market and you get an offer letter, and there is an anticipated employment for you to be starting, we can qualify you for a loan that way. Kind of the same way with the temporary employment or the furloughed employee is, if you're going to be starting that job before the first payment date, we can qualify you. And then if you're starting after the first payment date, so long as it's within 90 days of the closing date, we can qualify you also. There's just different requirements and reserve requirements for, each situation. So just know that there are options out there for everybody. Even if you're unemployed, you've been laid off, but you have reserves in the bank, there's a way to qualify you using an asset-based income calculation. So, it's just really important that, when you're working with your loan officer, that you give them your full financial picture so they can figure out what works the best for you.
Yeah, and good point. I'm going to throw in a plug here real quick and get to a couple more questions, but you set it up there. if you're watching this and you already have concerns, or you want to explore getting pre-approved, or you don't know when or what to do, just reach out to me. Let me help you. Let me guide you. I don't care if you're buying a year from now or a month from now, whatever. You want to bounce questions or whatever, you just call me up. Okay. Don't just guess. I'll put my number and contact info in the post so you can all see it, but reach out to me and let me know how I can help. What about lower hours? What about reduced hours? Because we literally got one about an hour ago. They're making less money right now, still working, but making less hours.
Mm-hmm. So we are going to have to look at what's going on there. And what the underwriter is likely going to do is they're going to ask for the most recent pay stub prior to closing for that borrower. Because that's something we're having to do right now just to see, in cases like this, what's happening. And they're going to recalculate the borrower's income, because what we do is we use the lowest, what's called the lowest average to qualify. We look back and we look at a year-to-date plus a previous 12-month history, or we look at a year-to-date plus a previous 24-month history. And whatever that lowest average is, that's what we're going to be looking to use to qualify the borrower for their new mortgage payment. So not knowing if the new lowered hours is going to be permanent, or at least permanent for the foreseeable future, that's why we're going to take a look at that income calculation and refigure it.
Okay, what if, so this person worked 40 hours a week, right? Up until coronavirus hit. Now they're down to like 25, but the employer gives us a letter stating they're going to be back to working 40 hours, same as a furloughed employee. Like they're going to be 40 hours a week starting May 1st.
Right. If we have an explanation like that from the employer, we can apply those temporary income guidelines to help qualify them. So, we will be looking, do they have reserves in the bank? We want to see what makes sense for that borrower and ensure that, they're going to be able to make their payments.
Okay. Gotcha. All right. So a couple more things.
Sure.
When we're going through the process now, what's changed as far as verifying employment during the process? For example, all the way up to where closing, right? We're verifying employment.
Mm-hmm. So VanDyk has come out, and across the board, we are re-verifying employment for everybody 2 days prior to closing. That's 2 business days prior to closing. So where that used to be 10 calendar days or 10 business days, depending on what kind of program you were applying for, we've come out and across the board said within 2 business days of closing, we're going to re-verify employment for everybody. We are also looking to see what kind of employment the borrower has, what position, what type of company it is. And if it is in an area where there is like a stay-at-home or a shelter-in-place order, or, non-essential employees or businesses have been closed, we are going to be asking for updated either bank statements or pay stubs showing the most recent income activity to know whether or not those borrowers' hours have been reduced or cut. Or, the concern is out there that employers, especially larger corporations, like I'm going to use Bonefish because that's one that has come up recently for me with some borrowers, is that, Bonefish is verifying that someone's fully employed because Bonefish has gone and taken the PPP and, whatever other kind of stimulus is out there available to businesses, and they are still telling us that the borrower is employed. However, the borrower is really not employed. They're getting, a small wage from Bonefish. I think it was like $400 a week or something like that, and that's nowhere near the income we've used to qualify them. So just knowing that, you're in the restaurant business, you're likely not working a full schedule, earning full tips, stuff like that. So, that's why we've come out and said, we're going to be asking for your most recent payroll somehow, showing that it supports what we use to qualify you.
Okay, gotcha. What about FHA loans? A lot of credit score changes and overlays. Can I tee this one up for you real quick?
Yeah.
Okay, cool. You're the man, dude. Thank you for letting me tee it up. So the FHA, with a lot of changes have happened out there. I've got friends in the business They can't do under a 680. They can't do under a
Hmm.
660. You saw the text I showed you right before a call came on. Someone texted me, can we do a 600 credit score?
Yeah.
And, you know, a lot of changes have happened. And for us, it really starts at that 640 credit score mark, going down from there. So can you touch on that some?
Yeah, certainly. So VanDyk Mortgage, we are still doing loans for borrowers with less than a 640 credit score. For conventional loans, you know, Fannie Mae allows you to go down to 620. Freddie Mac doesn't even actually have a minimum credit score, so long as you can get an LP approval, you know, we're good to go. For FHA, we will go all the way down to a 580 credit score. We do have some extra guidelines in place for borrowers with a less than 640 credit score. Depending on what their debt to income ratio is, we also have extra reserve requirements.
Right.
And again, that's just to help mitigate risk, not knowing what that financial picture is going to look like for the borrower in the next 2 to 3 months, to make sure, you know, they have some kind of pattern of savings, and, you know, we know that they're being responsible with their finances and their money.
Yeah, and if you're listening to this, also the one thing that's also called is overlays. You know, Rich is talking about with the debt to income ratio overlay or the reserves. These are things that we do, right? Rich is VanDyk Mortgage.
Correct. That is a VanDyk Mortgage. Yep.
Right, where some other companies, their overlays are, they ain't doing a 680 or lower credit score for FHA
Right.
or a 660.
Yeah.
And we
Right.
still
So
can, Rich.
we absolutely still can. So for example, FHA says you can go all the way down to a 580 credit score with only requiring a minimum 3.5% down payment. And, you know, we'll still allow for that, just with the additional reserve requirements in place if your DTI is, you know, over 43%.
Mm-hmm. Right, right. And, you know, a warning out there, the pricing has gotten a lot worse for
Right.
those programs. You know, there's discount points involved most of the time. And, you know, we've been telling everyone, Rich, if they're a realtor, that when you have that FHA borrower, even the better ones, you know, the higher scores, be prepared to ask for more seller concessions because of the discount points that are going to be have to be charged to some of them by some lenders. So it all depends on credit score and loan amount and things like that. But that's just kind of what we've been telling everyone: be prepared for seller concessions.
Yeah, for sure. And there's a lengthy explanation for what's happening in the secondary markets and with servicers and everything, and how there's basically less of an appetite for government loans right now because of the financial burden it is, you know, when you're servicing those loans after closing, and the financial commitments that all the lenders are in. But, you know, the long and short of it is it's a reaction to what's going in the secondary market, why the majority of lenders are coming out with, you know, very strict overlays and stuff like that.
Yep, yeah, dude, you crushed it as usual, man.
That's it. We're
Yeah,
done.
well, you got something else?
No, that's great. I didn't know if we made it through everything. Looks like we did.
Yeah, yeah, you hit them all. Yeah, you hit them all. No, you did good, man. This is if you're still watching this, these are things that are happening in your market. Will they be permanent? Who knows? You know, you see things, right, go up, go down, sideways, whatever. If you are still watching this, though, please understand. I feel like I gotta stress this. You know, the crash that Rich brought up in 07 and 08 and that we both went through, it's different on the housing side than it was then. You know, so many A paper or solid deals that we've closed in the past, 12 years, man? Is that long?
Yeah.
Holy cow. Yeah, 12. I forgot. 12 years. And so you don't have all the adjustables and the negam and the balloons and
Right.
prepaid penalties, all that stuff. So like, I wouldn't, I put myself on video. I wouldn't stress too much about a housing crash. Prices decline, probably. I mean, but I can tell you though, if you're watching this and you're thinking about buying, there are thousands of people like you that are sitting here watching this thinking about buying. And when they're waiting for the stay-at-home orders and the shelter in place and all that stuff to be done to where everyone get kind of back to business to normal and they want to buy. If you are one of those people, I want to help you. So give me a shout. I'll coach you through what you got to do. Call my cell, 239-910-5668, nights, weekends. Only time I'll pick up the phone on nights when I'm coaching Little League, which is not happening right now. So call me then. So
All
Rich,
teammates
dude,
board.
yeah, right. Coaching third base, taking phone calls. They get pissed off at me. Rich, you got anything else you want to throw in there, man?
Just thinking about even buyers in the market right now or people in the market right now, you're living in an apartment or a condo and, you're just not sure how long this stuff is going to go on, might be a good time to think about what it's like to be a homeowner in a single family home with a yard and everything like that, get more room to spread out, be outside more, less crowded areas, it's just it could be a great time coming up for that.
Yeah, dude, that's going to be pretty wild to watching the urban, right? Like, are they going to bolt? Are people going to get the hell out of there? Yeah, I don't know how they do it, man. So we're down here in Southwest Florida, not on top of each other.
Plenty of homes, plenty of space.
That's right. Come on down. Unless you're from New York City right now, then stay away.
Right. Yeah.
Just kidding, New York. Kind of, not really. But all right, Rich, brother, I appreciate it, man. Thank you, sir.
All right. Awesome. Thanks, Tim. We'll see you soon.
No problem, buddy. Thank you. Thanks for watching, everybody. Appreciate it. Bye-bye.